Welcome to this explainer. Look, have you ever wondered why two companies in the exact same industry can have wildly different stock returns? As a senior analyst, I spend a ton of time looking under the hood of different businesses. And let me tell you, most people look at entirely the wrong things when picking stocks. They get caught up in the marketing or, the flashy products, but they completely miss the invisible engine actually driving the car. So today, I'm going to show you the master's playbook to protect your money. We're going to learn how to identify those rare management teams that actually build your wealth, instead of secretly destroying it. To kick things off, let's look at this quote from the legendary Warren Buffett, which perfectly captures the reality of business. He points out that over 10 years, a CEO retaining 10% of net worth annually will end up deploying more than 60% of all the capital at work in the business. Just let that math sink in for a second. More than 60%. Let me translate that. If a CEO gets this wrong, it literally doesn't matter if they have the best marketing or the sleekest product on earth. Your investment is a sinking ship. But if they get it right, your money compounds while you sleep. A CEO's absolute make-or-break job isn't daily operations, it's deciding exactly where the cash goes once it comes in the door.
And don't worry, we won't let the financial jargon overwhelm us. Here is our roadmap for this explainer. First, the CEO's true job. Second, the 5 choices. Third, the outsider playbook. Fourth, the masters. Fifth, wealth destroyers. And finally, your scorecard.
Okay, part 1, the CEO's most important job. Let's pull back the curtain on the corporate boardroom and define the actual game being played here. Capital allocation is simply the financial mechanics of what management chooses to do with the cash a business generates every single year. You kind of have to think of the CEO as an investor. The business generates a big pool of cash, right? And the CEO's primary job is to take that pool and place it into different buckets to generate the highest possible return for you, the shareholder. If they're bad at this, your wealth stagnates. If they're masters at it, your wealth compounds miraculously, turning thousands into millions over a few decades.
Moving right along to part 2, the 5 capital choices. Now imagine we're standing at a whiteboard right now, mapping out what we call our capital allocation tree. It sounds like a complex job, but the truth is a CEO's options are actually surprisingly limited. When that profit rolls in, it branches out into only 5 distinct paths. 1, they can reinvest in the existing business, like building new factories or funding R&D. 2, they can acquire other companies through M&A. 3, pay down debt to strengthen the balance sheet. 4, pay dividends directly to you. Or 5, buy back their own shares. And really that's it, the whole shebang. The mix a CEO chooses from this whiteboard entirely determines the company's future. If their core business has massive returns, absolutely, they should reinvest. But if they don't have good internal projects, they better be paying a dividend or buying back stock. It is a precise, rational decision tree. Up next, part 3, the outsider CEO playbook. So William Thorndike studied this rare breed of CEOs he called outsiders, who just heavily beat the S&P 500. And their playbook requires a total psychological shift from what you normally see in corporate media. Outsiders act like cold, calculating investors, obsessing over per-share value. Meanwhile, your average CEOs? They act like empire builders, obsessed with total company size. Look, an empire builder wants a bigger company because it strokes their ego and gets them on magazine covers, even if they have to issue a ton of new shares to do it, which, by the way, heavily dilutes your slice of the pie. An outsider CEO doesn't care about the overall size of the pie. They only care about making your specific slice as rich and valuable as possible. They are brutally honest, highly rational, and they completely ignore the marketing fluff.
All right, part 4, masters of capital allocation. Let's actually look at how this plays out in the real world with some heavy-hitting masters of capital. Between 2013 and 2024, Bajaj Auto stock grew a staggering 5x, even with flat motorcycle sales. Think about that for a second. How on earth does a company's stock skyrocket 500% when they aren't even selling more bikes? Well, think of it like a pizza. If you own a slice and the CEO uses company cash to buy back half the other slices and throws them away, your single slice just became a much bigger piece of the entire pie. That is exactly what Bajaj did. They bought back undervalued shares to shrink the share count, meaning the remaining shareholders suddenly owned a much larger percentage of the company's profits. Pure genius.
Then we have TCS, giving us the best of both worlds. They drove their market cap from 3 lakh crore in 2010 to over 15 lakh crore today. How? by paying massive dividends, often 60 to 80% of their profits, and buying back around 50,000 crore rupees worth of shares at fair multiples since 2017. But here is the kicker. They completely avoided reckless, pricey acquisitions. Let's be real, it takes immense discipline for a CEO to sit on a mountain of cash and ignore all the Wall Street bankers pushing them to buy other companies. TCS just stayed in their lane, focused on core IT services, and funneled an absolute river of cash back to their investors.
Now, for the dark side. Part 5. Wealth Destroyers and Traps.
For every master, there's a trap. And as your mentor here, I absolutely want to keep your money safe. We have to talk about human psychology, specifically what the brilliant Charlie Munger called incentive-caused bias. Munger warned us that bad management usually stems from this bias, where executives aggressively build empires just to boost their own status and paychecks. If a CEO's annual bonus is tied to the total size of the company, well, you better believe they're going to rationalize terrible, wildly expensive acquisitions just to make the company bigger, even if it totally destroys the actual per-share value for you and me.
The contrast is just stark. On one hand, you have the boring cash-generating brilliance of TCS and Bajaj Auto. On the other, you have the flashy, debt-fueled expansions of Yes Bank or Anil Ambani's empire. Anil Ambani took a massive 70,000 crore windfall and recklessly expanded into telecom, power, and infrastructure using absolute mountains of debt. Yes Bank chased high return on equity through incredibly risky corporate loans. Both were classic empire builders trying to conquer the world, right? And both ultimately led to total ruin and bankruptcies that completely wiped out massive shareholder wealth. That, right there, is the devastating danger of incentive-caused bias in action.
Which brings us to Part 6, your management scorecard.
So how do we actually use all this to protect our portfolios? You need a reliable way to separate the masters from the empire builders before you invest a single dime. I highly recommend keeping this scorecard handy. First, check the quantitative metrics on the left. Are they generating consistent free cash flow? Basically, actual money left over after paying the bills. Is their return on incremental invested capital stable? Meaning, for every new dollar they put into the business, are they actually getting a good return? And are they doing buybacks at fair prices rather than foolishly buying at market peaks? Then, you got to check the qualitative signals on the right. Are their annual letters brutally honest about mistakes, or is it just pure marketing fluff? And critically, are there complex related party transactions? Because as Charlie Munger often warned, complex accounting is almost always hiding something really bad.
You also absolutely must look for skin in the game. This means management holds a massive personal stake in the company. When you look at companies like Bajaj Auto with roughly 54% promoter holding or Reliance at 50%, you know for a fact that people making the capital allocation decisions are going to feel the exact same financial pain or gain that you do. Look, if management is consistently selling off their own stake while telling you to buy, run the other way. Literally, just walk away.
It all goes right back to Warren Buffett's bedrock rule. I want managers who think and act like owners. Because when management has skin in the game, acting like owners with their own money on the line, their financial incentives are perfectly aligned with yours. They're sure as heck not going to make a reckless acquisition just to get their face on a magazine cover if it's going to destroy their own family's net worth. So take a hard look at your own holdings today. Apply this master's playbook, check for skin in the game, and ask yourself, is your hard-earned money being grown by a disciplined allocator who respects per-share value? Or is it being secretly destroyed by an empire builder chasing their own ego? Make sure you're backing the true capital allocators. Thanks for joining me on this explainer, and I'll see you in the next one.